everyone, and welcome to episode 85 of the Rewarding Property Decisions podcast. So all the talk in media circles in recent weeks has been that Melbourne's definitely the ugly duckling of the Australian property market, whether it's the poor growth that Melbourne's certainly seen over the past 2 to 3 years, investors that are leaving the market. There's limited buyer numbers at present. We certainly aren't seeing the levels of competition. That's evidenced by clearance rates. And then obviously the increasing ownership costs that seem to be applicable to Victoria. So why would you want to buy there with all this negative talk around Melbourne specifically? So I may sound a little bit biased when I go down this track today, and some of you may even feel as though it's a little self-serving, but I do really feel that Melbourne's actually quite good value at the moment, and I think it's actually probably the place to be purchasing within the country. And we'll go through the reasons why. We'll go through the reasons today why I feel as though some of the statistics and some of the reasoning behind Melbourne's poor performance can actually be seen as a bit of an advantage to be taken. So why has it been performing poorly against the other capital cities in recent times? And there is a number of reasons, and they are very much Victoria specific. A lot of those are related to some of the decisions that the government has made in recent times, and a number of them are targeted particularly towards investors, and so it's making investors second guess their thought processes at the moment. Now, the most obvious one, and we'll go through that one first, is obviously land tax. Now, what's happened, for those that don't know, as of the start of this year, that the land tax assessment threshold, which previously was $300,000, has now been reduced down to $50,000. So what that's meant is that it's led to increased holding costs for a lot of investors and as a result as well, and I think this is actually quite a good one, is that you can no longer, when selling a property, apportion value but from the vendor to the buyer in terms of the land tax. And what that's meant is a lot of investors are actually now starting to hurry through. They've felt the extra cost of land tax this year, and so they're trying to rush through at the moment, selling properties so that they can hopefully get them settled by the end of this year, because land tax is actually calculated on a calendar year rather than financial year basis. So for those that perhaps, and there are a number who've never had to pay land tax even on investment properties in the past, because for those owning apartments, it's been, and with a $300,000 land component, a lot of apartments don't have that level of land value. Whereas now, nearly all of them would have $50,000. So it's a much wider grouping or inclusion rate of properties that are included within that land tax assessment. So it's meant that there's a lot more costs for some people to have to pay. Another one that's led to this is the changes that are coming into play as of the 30th of October next year for landlords. So there's an extra expectation. There was another change back in 2021, and there's further ones coming in October next year, or have to be done by October next year. They're revolving around ceiling insulation, draft proofing properties, and adding air conditioning as well. Now, on their own, a lot of these things are absolutely valid and are really good things to be doing. They're going to, particularly around the air conditioning side of things, they'll increase values of properties as well, because from a tenancy perspective, people will certainly value that. But the intention here is to support tenants, and with the increased rental costs and the rental levels that have been going on in recent times, landlords are likely to want to get returns on their investment, and particularly around air conditioning. If you've got a property that includes air conditioning versus one that doesn't, it is going to increase the rental costs. So it may not necessarily have the desired result. The next one, which is probably more of an across-the-board thing, is interest rates. Now, the thing here is that, yes, they are Australia-wide, but interest rates have a much greater impact on a soft or stagnant market than they do on a rising market. And we're certainly seeing that in Melbourne in present times. The idea of increasing interest rates, obviously from the Reserve Bank's perspective, is to try and cool inflation, cool spending, that sort of thing. And for the majority of the country, that's actually the target, and that's where we want it to be. The problem in Melbourne is that you're targeting a market that's already stagnant, and all that does is further cool it and make buyers less inclined to be getting involved. So when you've got a stagnant market that then gets interest rates increased, it really starts to put pressure on and increase the cost of living, obviously, for those that do hold a mortgage or second guess whether they want to add to their mortgage. And then the last one, which is coming into play as of the 1st of January next year, is the Victorian government's looking to introduce a 7.5% levy on short stay accommodation. Now, this is being referred to as the Airbnb tax by a lot of people. What it's also going to allow is local councils and owners corporations will give them the powers to either ban or limit the amount of short stay accommodation within their controlling area. Now, the intention for this is to try and convert short stay accommodation to long-term rentals so that there's an increase in supply of rental properties, and hopefully that puts pressure on rentals and starts to push things down. Now, that will certainly work in some instances, I think. There'll be some that will convert short stay accommodation to long-term rentals. But the other thing that it's going to do is it's going to increase a lot of these short-term landlords will pass on their 7.5% to the residential accommodation. They will just increase the cost of holidays, which further increases inflation. But for others, it will just lead to them saying, look, combine that with the fact that now I've got more land tax to pay and I've got these other expenses that I now need to contribute to. I'm just going to sell the property. So that takes more property out of that rental market. Now, the argument there is, well, it's taking short-term, it's not taking long-term markets. So that's a good thing too. But is it really going to support that rental market? I'm not necessarily convinced of that, that it's going to have a significant impact. I think it will have a small, but not necessarily the significant part. Now, another big thing that's being talked about around Melbourne property prices is looking at statistics. And the fact that where Melbourne now sits in the grand scheme of things in terms of median prices against other capital cities within the country. Now, we wrote an article for the Fin Review a couple of weeks ago on how to look at statistics and to make sure that you are digging a little bit deeper rather than just taking the word for it, because there's statistics and there's statistics. So from what we're considering, Melbourne as a city, particularly comparative to, say, the smaller capital cities like especially Adelaide and Perth, lesser extent Brisbane, but Melbourne is made up of a much larger portion of apartments as a proportion of its total properties. And so it's important to understand when statistical companies talk about dwellings that they're actually incorporating all property types. It's not just houses, it's not just apartments, it's apartments, houses, units, townhouses, all encompassing. So you're looking at all of that. And when you've got a market that is a little bit more skewed, like say Melbourne is, there's a much larger proportion of apartments within the market than what there is others, it starts to impact on the data. And a really good example of this is comparing Melbourne to Adelaide, because Adelaide has just gone above Melbourne from a median dwelling price perspective. So if we look at the numbers, Melbourne's median dwelling price at the moment is circa 776,000. Adelaide's has just gone to 790,000. These are according to CoreLogic. But if you dig a bit deeper and look at the housing prices, so compare Melbourne's housing median price to Adelaide's, the house price is 944,000 for Melbourne, and for Adelaide it's 830,000. In the apartment market, for Melbourne it's 610,000, for Adelaide it's 546. So when you compare apples with apples, Melbourne's still comfortably ahead. But when you group them together, because of the proportion where I believe it's around 33% of dwellings in Melbourne are apartments versus about 16% of dwellings in Adelaide are apartments, the data gets skewed. So it's really important to dig a bit deeper rather than just look at Adelaide's dwelling median price is higher than Melbourne's. Is it really? And we need to look at that and why. So why do I think that Melbourne's now a good option from an investing perspective? Well, to start with, many of you have heard me say this. I like to recite Richard Wakeland. There's a reason this business is still named after him and why he started and did so well. He's always said the longer a market is held back, the greater the rise will be when it does recover. Now, Melbourne, when you look at things, hasn't had a significant holdback yet. but it's probably still got a little way to go before it starts to really appreciate again. And a good example of this held back, the longer it's held back, the greater the rise. If you look back at, say, the 90s, when we had the recession in the early 90s, the market really didn't do anything until about 1997, and then we had an extended period of 10 years till about the GFC in 2008 of sustained, consistent and pretty strong growth over that period of time. If we look at the last 4 years, so pre-COVID to now, so 2020 to now, Melbourne's growth has been over that period about 17%. Sydney was 36%, and then you jump Brisbane 73%, Adelaide 74%, and Perth 74%. And of that 17% of Melbourne's growth, 14% of that was in the first 12 months when everyone was realising that they were going to be locked down. Everyone wanted to improve the quality of housing, and they knew that they weren't going to be able to renovate, so that there was that really driving force of wanting to upgrade. But since then, Melbourne's done nothing. The other cities have continued to move along, particularly the smaller cities, at a much greater rate. So I think there's certainly very strong room for improvement. Melbourne's fundamentals are still very much there in terms of being a global city, and the financial and the economic benefits that this city does offer, the livability that it offers, means that there's still going to be really good opportunities for growth. The next is that there's been limited buying competition in recent times, and I think that's likely to continue. So that's obviously illustrated in the clearance rate. We spoke about this in the spring market preview that I did a couple of weeks ago on the podcast. The year started quite strongly from a clearance rate perspective. It was around the 70% mark, but over recent times, it started to slide back, and we're currently sitting around the early 60% mark. And as I've said previously, what we're expecting is that as you get further into the spring market where the supply really starts to lift up, from there, the clearance rate typically drops off. So I won't be surprised to see the clearance rate dropping below the 60% mark down to the potentially even early 50s by the end of the year, which presents some great opportunities from a buyer's perspective. And then if we look at the supply level, which is also quite good at the moment compared to 2024's levels, on a weekly average basis, we're anywhere between some weeks 17%, but in some instances it's been as much as 35% up on this time last year, which is significant in terms of the supply level. So there's good choice around at the moment. The thing to be very mindful of, particularly as you get further into the spring, is that the quality may not necessarily be there. So just because the supply numbers are up doesn't mean the quality of stock is there as well. But that high supply, limited competition from a buyer's perspective is ideal. So there's some really good opportunities around at the moment. The other benefit of why I think it's good time at the moment is the rental market. Now, median rents at the moment for houses from January 2023 to now are up by as much as 19%, and from a unit perspective, they're up by as much as 17%. So that's a strong rental growth, and I think that the potential for that to be sustained and then continued to build on is certainly still really good. The vacancy rates at the moment are around 1.5%. At its peak, it was sub 1%, which was around the peak rental market, which is typically sort of late January to the end of March. That's typically when we find the rental markets at its strongest, and I would expect that to happen again in 2025. So for those buying investment properties now, settling them in the early part of the new year, there's some good potential to achieve some premiums from a rent perspective at that time. So that's another benefit, I guess, as well. There has been some expectation that the rental market might start to level off now. I think for other capital cities that could be the case, but with the way Melbourne is at the moment, one of the key factors in considering that it might be starting to cool is that there's been an increase in investor lending. It's up about 35% on this time last year, so more investors in the market. The issue is that those investors are not buying in Melbourne at the moment. So that buying those investment properties in the other capital cities increases the supply, and hopefully that starts to cool the rental market. In Melbourne, we're actually seeing the reverse, in that a lot of the investors are leaving the market for the reasons we've spoken about around land tax and costs and those sorts of things. So that's reducing the number of rental properties, and as a result, there's higher pressure on rental values. So I think there's still quite good potential for the rental market and the rental cost to continue to increase throughout the balance of this year. And then the final one is obviously interest rates. Now, from all the experts' perspective, and I certainly don't count myself as one of those from an economy or an interest rate market point of view, But if we haven't reached the peak, we're very close to it from an interest rate point of view. And so the general expectation from all the reading that I've done is that at some stage next year, we're going to start to see things come down, if not even earlier with the recent US reductions. So that will most likely start to ease pressure, and it will mean people will start to look at options. So what that will do is then that's when the market will start to lift. So ideally, as an investor, you'd like to get in before that starts to move. Now, I don't think that'll be a quick shift around, and in terms of immediate, the market's going to take off in Melbourne. But I think at some point in time, it is going to turn. And what we typically have known and have seen is that when it does, you then start to play catch up. And that's a lot harder from an investor's perspective. And no one likes to have to start to pay premiums in order to get the market to work for you rather than against you. So that's my thoughts why I think there's some really good reasoning why it is a good time at the moment to be considering Melbourne from an investment perspective. Obviously, your own personal circumstances come into play and need to take serious consideration before making that decision. But I think if it is something you're looking at, then there is some good opportunities to be had. So thanks for joining me for episode 85 of the Rewarding Property Decisions podcast. As always, feel free to share the podcast far and wide with friends, family and colleagues. If you would like further information on making rewarding property decisions, please visit our website, wakeland.com.au. Otherwise, we'll look forward to seeing you at the next episode. Thank you.